And now it's time for development debates. We dig deeper into some of the questions shaping the future and present of China. Today, we'll see two Chinese experts debate if the central government should ease rules on banks' loan-to-deposit ratios. The loan-to-deposit ratio refers to the percentage that loan assets occupy in deposit liabilities for commercial banks. The ratio is mainly used for controlling the lending scale of commercial banks. In 1994, China suffered over 20% inflation. Then in the next year, the China Banking Regulatory Commission made the ratio for commercial banks not surpass 75%. That is to say, Chinese commercial banks can only lend 75 Chinese cents for every 1 yuan they collect from depositors. The central government believes this method could help prevent serious inflation from happening again. However, the country's decreasing GDP growth rate has forced the government to find other solutions to avoid the situation. So now it seems that changing the rules on the loan-to-deposit ratio has become an option. As Southern Metropolis Daily reports, last week the China Banking Regulatory Commission announced that it would change the way it calculates the loan-to-deposit ratios for Chinese commercial banks. It's estimated the change will bring extra 800 million yuan, or about $130 billion in credit supply to the market. The Chinese government hopes this money could be used for supporting China's small and micro-sized agricultural businesses. However, some Chinese experts don't think the ease on the loan-to-deposit ratio policy can help bring positive effects to China's economy. Researchers at the Shanghai Institute of Finance and Law, Nia Ming, wrote an article pointing out the government should abandon setting up the loan-to-deposit ratio. Nia wrote that it's inappropriate to let the China Banking Regulatory Commission intervene in the bank's micro-businesses. Under the market-oriented economy system, the government shouldn't tell commercial banks which industry or company they should lend money to. Nia said the government setting up a loan-to-deposit ratio is mainly for curbing lending by commercial banks and to prevent a liquidity crisis. However, Nia doesn't think using this monetary instrument can truly support these businesses the way the government hopes. Nia said that Chinese commercial banks shouldn't be blamed for not lending to other companies. One issue is that these businesses lack financial transparency. Commercial banks cannot take huge risks by lending money to them. So Nia points out that this situation cannot be changed even though the government enlarges credit supplies by changing the rules on loan-to-deposit ratios. Instead, Nia suggests the Chinese government should cancel the loan-to-deposit ratio to activate China's economy. However, financial commentator Qing Yi doesn't support Nia's idea. Qing wrote on his blog the government set a 75% loan-to-deposit ratio in 1995, which curbed Chinese commercial banks from lending money. Qing said that before the policy had been implemented, the ratio for Chinese banks could reach 100% or even 130%. In order to support lending, they would use high interest rates to absorb deposits. In the end, most Chinese banks suffered heavy losses, and it also caused the percentage of bad loans to increase dramatically. Qing pointed out that abandoning the loan-to-deposit ratio would be equal to the required reserves for commercial banks. This could give commercial banks more money for lending to China's small farming businesses. However, interest rates would still stay to a high level, and they still cannot ease financial pressure on Chinese companies. The high interest rates would bring these companies more difficulties when the country's economic development slows down. Qing said the fundamental issue is the government can reduce the country's high financial costs rather than increasing credit support. The central government wants to ease rules on the loan-to-deposit ratio in order to support China's economy. However, if commercial banks treat it as a new opportunity for exploiting customers, the policy would turn into a new round of bubbles created by the government.